Ladies and gentlemen, good morning and welcome to our first review of the markets for the month of April. April tends to be the last month with positive equity seasonality, and we are still stuck in fourth waves in just about every single market that we follow. The 5-year note yield, as expected, has retraced in an area around between 2 and 1.9% and is firmly stuck here for the foreseeable future. We think the path of least resistance is probably for slightly lower yields to test this very important trend line, which lies around 1.82%. Our preferred path of least resistance is down, but not very much. We think we shall still trade in this area bounded by 2% on the upside and 180 on the downside for quite some time. The 10-year note is exactly in the same position. It is testing this downtrend, this support line. It is likely to try and break it to the downside and get to the 0.382 retracement around 213, which is going to be very difficult to break. But for the time being, we see trading in a range between 248 and this very important level at 213 without too much drama in the 10-year note. What is significant is that the spreads keep on narrowing. You have the 5-year to 10-year yields still narrowing to around the 40 basis points, which is about as narrow as it has been since the 2008 crisis. It is puzzling that none of these spreads, 5s, 10s, or even 5s, 30s, is able to break out of the downtrend for a flatter yield curve. Flatter yield curves imply that there is very little fear of inflation and very little fear of accelerating growth, and in fact can even be suggestive of a downturn in the economy coming fairly soon. So that is what we are watching and what is still puzzling to us. We are not yet ready to make a call that we are going to see deflation or a pronounced fall in economic activity until we break this kind of level around the 100 mark in 5-year to 30-year yields. If we do break that, we think that probably XLF is in serious trouble, and other markets, other equity markets, will be also in trouble. The 13-week bills against the 5-year note is coming to very important levels, and should we break this to the upside, we will be also very worried about a coming recession. But it is just too early to call any major implications from a flattening yield curve. The situation in Europe and Germany is much the same. We still, as expected, cannot turn significantly up in terms of yields. This is a 2-year note in Germany. We are still stuck between, say, 64 basis points and 88 basis points. We are much better sellers of contracts when we come down to the -88 mark. but it's still gonna take many weeks of price action before we can say that we have turned the corner. If we look at 5-year notes, we are very neutral. We could see easily a move back to minus 55 basis points in yield, where we also want to put on short contract trades in the bubble for higher yields. But the situation really has not changed. We are stuck in a 20 basis point range, which we have been stuck in for several quarters now. The the tendency for a steeper yield curve in Europe, we think, is now out. We think that it is more likely that we will see falls in terms of it falls in yields in terms of 10-year notes, while the 2-year and the 5-year do almost nothing. And that is something which is not supportive of Euro USD at the moment. We think that Euro USD will also be stuck, but we'll see that in a second. And exactly as we forecast last week, Euro USD could not break the 200-day moving average. It tried, failed, and gave up all the gains of the past couple of weeks in 3 or 4 days of price action. It is unlikely that we will now fall any lower than 105.20. That is going to be a wonderful level to reinstate longs. 106.50 to 105.20 to us is a buying area, and we will definitely put on long trades in Euro USD at these extreme levels of 105.20. We've just seen that both US and EU yields are more or less stuck. Therefore, there is no reason to expect a trend to appear out of the Euro USD because of interest rate price differentials. Therefore, this reverts to a trading market with 105.20 to 106.40 as the accumulation area for breakups towards 108. The dollar index confirmed our thoughts last week that it was very dangerous to be short of it. It has bounced significantly, and we now think it is going to test the 101 area and trade between 101 and probably the level of 99.85. 101 to 99.85 should be the trading range for a bit before the contract decides which way it wants to go. We keep on saying that this 102.23 area is very important. We don't see it being tested in the next few weeks, but if the market for the next month or so cannot regain it, the likelihood of breaks of this uptrend line increases, and the likelihood of big falls in the dollar index increases exponentially. It is just too early to call. We think it'll trade in this area for the foreseeable future, and then we will reevaluate. But this is a trading market, not a trending market, so we will act accordingly. In US equities, the situation is very little changed from last week. We thought that the 2320 area would be almost impossible to break, and so it proved. It bounced very violently back up to 2360 odd. Now we think the 2340 area is going to be equally difficult to break on a closing basis, and probably so will be the 2390 area. So we are stuck in probably a 2 to 3% trading range for the foreseeable future, and we shall act accordingly. When the market is stuck in tighter trading ranges, it is most profitable to trade a variety of spreads. This is a long-term chart of XLK over XLI. As you can see, XLK has been leading the rally, and XLI has very much lagged. We think that XLK is now very close to topping out areas, and it is very dangerous to be long of it relative to XLI. So we shall be looking for areas to put on short XLK trades. The very interesting chart is one of SPY against IWM, which is the Russell 2000. The 200-day moving average is capping it at the moment. We are probably ready to break down in terms of the spread, which would indicate that the Russell 2000 is a better long than SPY. We are still unconvinced, and we would still like to see several days more of trading before we put on a position here, but this could be the best risk on indicator that would signify that prices are going to appreciate significantly in IWM relative to SPY. SPY will probably do nothing while IWM catches up. From the beginning of the year, you can see the IWM has done nothing while SPY has been going up. Well, that trend could be about to reverse. We would like to see it convincingly break this 50-day moving average to signify a return to the lows seen in late 2016 and the beginning of 2017. The one market that we are beginning to be very weary of is XLF. This is a chart of a 13-week T-bill against a 5-year note. The idea is very simple. When short-term rates are low and long-term rates are high, the banks make larger profits on their spreads because they borrow short and lend long. You can see how this market has always moved in parallel with XLF, and how here it led the thrust higher in XLF. Well, at the moment this is doing very much the reverse. It is falling, indicating a smaller profit margin for the banks. It is quite likely now that XLF could make a rapid move lower and try and fill these gaps around the just below the 22 level, around 21.5 or so. Well, if that does happen, we will have certainly a move down in SPY, the order of 2 or 3%. It's nothing that's going to happen in a day or so, but it just indicates to us that XLF might be the weakest component of SPY and the one that we want to short on any rally up. If you got the impression that we were slightly bearish of US equities, that is not so. We are not bearish. We think they are stuck in a trading range, and the one thing that alerts us to that fact is the relationship between HYG, which is junk, and TLT, which is long-term treasuries. It is basically going sideways, and has been going sideways since the big thrust in November last year, after the election of Donald Trump. If we're going to see any breakdown in the equities, we will definitely see a breakdown below this level of 0.71 in HYG to TLT relationship. we will not see any break in equities before that happens. And as you see last week, it basically went back to the middle of the trading range, which is exactly what the SPY did. So this is a very good indicator, and one which we will be following and tweeting you updates all week next week. One thing which is very notable is that the SPY FEU relationship, i.e., SPY against the European stocks measured in dollars, has done almost nothing last week. In a week where the euro against the dollar gave up 2%, and where SPY also rallied, we would have expected a much bigger retrace than we got. We ended up the week almost unchanged. And that tells us that this relationship at some stage is going to break down quite violently. So we remain much better buyers of European equities relative to US equities. We think there is much less risk in Europe than there is in the United States. Our biases for next week remain almost unchanged. 5-year notes and 10-year notes, we are still in the coiling triangles. The uptrend in yields seems to be completely exhausted, and the yield curve is still flattening. So being short of 5 years and long of 10 years seems to be the most profitable position still. The bunds and bobbles and the shats, we think the risks are all for higher prices and lower yields over the course of the next 2 or 3 weeks, as we're coming into French election time and the markets will be jittery. So being short of them at the moment does not look like good risk reward. The commodities are doing nothing. We're still watching them. We still think that at some stage those will be very important breakout signals, which will signify being long of commodities and short of bonds. We're nowhere near. We're watching it on a daily basis. Yes, the third wave is exhausted. We have retracement objectives which we have fulfilled, and now we think we are in a trading range. Every time we're bearish, we think put spreads are a much better and safer trade than being short outright. XLF, preferred short instrument. NQ, we are neutral simply because we think XLK has reached very important levels against XLI, and we can't see NQ therefore going up without a much broader risk-on thrust coming from XLI. Russell 2000, we're beginning to prefer Russell as we have for a long time. We're still waiting for the spread chart to confirm a risk on move and put on the long Russell short SPY trade. European equities, nothing's changed. As we just showed you, FEU much better long-term risk indicator, preferred risk on indicator than SPY. If by any chance we come back to 30-20, which we really don't expect for the time being, that'll be a fantastic long. And we are still watching the dollar. We think it'll trade now towards 101 and a quarter, but if it doesn't regain 102, the consequences will be a much lower dollar down the road. Nothing has changed here, but a word of caution: the risk on, risk off indicators are very inconclusive, which says do not get married to any position. We are in trading ranges and we do not expect breakouts, significant breakouts one way or the other. shallow extensions are preferred. Sorry not to be able to give you better news, but you have to trade what you see in front of you. Thank you very much indeed, and see you next week.